I want to talk about the notion of balancing our budgets and getting our economy in better shape by implementing austerity budget measures, which many governments the world round are implementing. Why do you think this is such a dangerous idea?
There's three reasons, Steve. The first one is that we can't all do it at once. There's a problem of composition. If everybody tries to save at once, there's no income from which to save. So you have to think about the relationship between spending and saving. While it makes sense to save, while it makes sense to clear your balance sheet of your company or a state, or balance your budget in general of your household, if we all try to do it at the one time, then all you do is shrink the economy. So a very simple way to think about this. Imagine a simple sum, a fraction, right? And on the top, you've got the numerator, and the bottom, you've got the denominator. So the top is the amount of debt you've got, and the bottom is your GDP, how much of the economy you've got. If everyone cuts and GDP gets smaller, what happens to the size of the debt relatively? It gets bigger. And every country in Europe that's undergone an austerity program now has more debt, much more than when they started. So if the point of the whole thing is to reduce debt, it's literally pointless if everyone tries to do it simultaneously. Number two, the next one is it's not fair. Who are the people who actually rely on government services? They're the people at the bottom end of the income distribution, not the people at the top. And the people at the top are the ones who, frankly, have made out like bandits over the past 30 years of the financialization of the economy. They're the ones, the creditors, who the low inflation regime has benefited. They produce the debt that masks the maldistribution of income right across all the OECD countries. And now, after bailing out the assets of the very people who created the debt, we're now going to say to the people who didn't benefit, you're the ones who need to pay. Well, that produces a very toxic and very dangerous politics. You have a kind of creditor-debtor standoff where those who can pay don't want to, and those who can't pay are being asked to. Look at the Italian elections. That's where this is the first round of this, and it could get potentially much worse. And that's what the lessons of history certainly tell us. Number three, the confidence fairy story is a confidence fairy story. If you really think about it, the whole notion that businesses waiting inside, sitting on piles of capital, waiting to invest, right? That's all true. Why are they doing this? Because they're uncertain about Obamacare. Well, only one country has Obamacare, and you've got lots of countries in recession. So what's really behind this? The actual argument for confidence goes like this. So imagine that the government decides to cut spending, and I'm a consumer, just your average consumer. Well, I look at my lifetime budget, and I say, hey, these guys are going to spend less money in the future. That means I have less taxes in the future. That means I have more money now. So despite the economy falling around my ears, I'm going to go out and spend more money now and cure the recession while it's ongoing. That's nonsense. No one it's a wonderful modelling contrivance if you're an economist, but it's a nonsense in terms of how it actually plays out in the world. So the confidence fairy is a fairy story. It produces toxic politics, and it doesn't work if everyone does it at the same time. Okay, so why are we doing it?
We've heard a lot about austerity and the need to reduce public debt in the run-up to the election from all the main political parties. What's your view on this and their policies?
It's naive. The most positive thing I can say about those views is it's naive and childish because they have a vision about how the economy operates that you might as well learn in a kindergarten class. We have Daddy who runs the household, and Daddy has to make sure that enough income comes in, and Daddy has to save, etc. Otherwise, the family will be on the street. And when you look at the way they talk about the government needing to run a surplus, and both parties are really selling this idea, it's really that kindergarten version of what a government and what an economy is like. Now, normally, I have quite a few fights with Paul Krugman, but I've got to say, with a few little nuances, completely agree with the argument he made in The Guardian long read just this last weekend to say that this is, you can't think about the economy and the government's role in the economy like a child might think about a household budget, which is all that's being sold by both politicians of both sides. And it is the public debt it's a sign of the state of the economy, but it's not a cause of the state of the economy. And by focusing on that and trying to reduce the public debt, they're likely to push the economy, first of all, into another slump, but also, if they actually succeeded in holding that level of surplus they're both fantasizing about, they'd cause the next financial crisis that way, or cause a serious decline in economic activity. They certainly won't cause what they both argue will cause, which is sustained economic growth.
So what should they be doing with the budget?
I think I've worked out a way that people can actually visualise this. I'll take you through a bit of a visual exercise. Draw a rectangle. Call that the entire economy. Okay? Divide it in half. One half is the government and the other half is the public. Okay? if the government is going to run a surplus, which is what both Labor and Conservatives are saying is their objective, and everybody thinks it's a good idea, that means that the taxes the government's imposing upon the public have to be greater than the spending that they also do to the public. So what you've got, therefore, is a flow of money has to be going from the public box, you've got there, the private economy, to the government. Okay? I'll call that flow of net gov. That means for the government to run a surplus, they've got to be taking money out of your bank accounts. Now that's, to begin with, that's the opposite of what people think. Okay? They think, oh, government saves money, I can save money too. No. If the government's going to run a surplus, it means it's got to tax the people more than it spends on the people, and therefore it is taking money out of people's bank accounts. Step one. Question is, where do you get the money? Now, if they do it once off, money comes out of your bank account, you can cope once or twice. If they're talking about doing this on a sustained basis, then you've got to have a sustained flow of money from the public's bank accounts to the government. So where do you get the money? Now, you can't print it yourself. Okay, we're talking money here, we're not talking selling widgets to the government. You've got to provide a flow of cash. Where do you get the money? You can only get it, we're not looking at exports just to look at a closed economy. Sure. You've got to borrow it from the banks. If the government wants to, you have a flow of money going to the government from your bank account to the government, then to keep your bank account constant, you've got to be borrowing money from the banks. So if you're going to have the government running a permanent surplus and the public having simply a constant amount of money in its bank accounts, there's got to be a constant borrowing of money from the banks to provide the money the government wants. Which means, consequently, you're getting to maintain the government surplus and help it reduce its debt, you've got to be going to get debt to the banks. Okay? Now, if you do that and you simply do it in such a way that you maintain a constant amount of money in the public's bank accounts in general, then the turnover of that money is what generates economic activity. So the only way you could have that situation of the government running a surplus, being financed by the public borrowing money from the banks to provide that money, therefore keeping a constant amount of money in circulation in the economy, the only way the economy could grow in monetary terms would be if that money turned over more rapidly. Now we know empirically it's been turning over less rapidly over time, okay? And its rate of turnover goes down during a crisis, not up. Okay? So if economic growth slows down, people hoard money, they spend less rapidly, it turns over less quickly, so you get a contracting economy coming out of that. Now, if you put that together for a substantial period of time, if you run a surplus 4 or 5 years, which is the sort of stuff that both parties are saying kindergarten style is a good idea, daddy's saving the money, what it means is you're going to have rising private debt with a relatively constant GDP, a rising private servicing pressure as well. At some point the public will stop borrowing money from the banks and you'll go into a downturn. So running a sustained government deficit is a recipe for a future economic crisis caused by the private sector getting into too much debt, stopping borrowing, and then the level of money in the economy going backwards, because as well as the government taking money out, people try to pay their debts down, the amount of money in the economy contracts and you go into a serious downturn. Now that, in a nutshell, is why Greece and Spain and Italy and France are in the state they're in right now. And both political parties are saying, we think it's a good thing to do the same idea. It's kindergarten thinking about the economy.
Why did I write this book? I wrote this book for the following reason. I got really, really pissed off with people with lots of money telling people who don't have any money they need to pay shit back. That's basically it. I grew up on the butt end of the British welfare state. I'm an orphan, and I was raised by my paternal grandmother. So I am the greatest living example of intergenerational social mobility you're ever going to see, because I'm a freaking Ivy League professor. So I went from there to there. How did I do that? Because of this thing that gets blamed called the welfare state. That bloated, paternalist, out of control, incentivizing, demotivating piece of crap called the welfare state. Now, why is this a completely bullshit story? Well, that's not, but why does it turn into a bullshit story? It turns into a bullshit story for the following reason. Back in 2000, the number one concern of financial markets globally was there wasn't going to be enough federal debt, because we'd balance the budget. And seriously, the number one concern is there wouldn't be enough T-bills, right? So, fast forward 13 years, right, we're all freaking out. Now, in between, a couple of interesting things happened. So you have a balanced budget, which basically means over time as the economy grows, your debt stock's going to shrink, and that's why people had a problem with it. So you're going through a rapid period of growth. This is the tech boom period, all this sort of stuff. And Then there's 9/11. So there's a little dip in the economy, and a guy called Greenspan comes along and says, let's cut interest rates and essentially do asset protection for everybody who's bought assets by giving them more or less free money. So then we decide on top of that, we're going to have 2 tax cuts. Why? Because we just need more money. Screw it. We're just going to do it. We'll have some tax cuts. No corresponding way of paying it off or whatever. We'll just take the tax cuts. And then we'll decide to fight 2 wars of choice for dubious political reasons without raising any taxes. That'll be a good one. So by the time you get to 2006, there's 61% debt to GDP already. I don't remember anybody in Congress, particularly Republicans, jumping up and down about the crazy level of federal debt in 2006. And then in 2007, 2008, there's a run on the repo markets. Basically, the hidden story of the financial crisis that nobody really talks about, is actually quite simple, is that because there was a shortage of T-bills, because in fact many of them were in China, because they keep buying a lot of them, we started to use AAA mortgage products as collateral for short-term financial deals in the repo markets. As the housing crisis happened, those bonds that made up those instruments fell from AAA to B to C. At that time, that meant that if you were a heavily leveraged financial organization, a Bear Stearns, for example, and you were using these things as pledges and as repo collateral, as they fell value, you had to use more and more of them to borrow the same amount of money. Unfortunately, you couldn't do that because there's a fixed stock of the assets and they're hugely levered. This meant a 3% return against their asset base rendered them effectively insolvent. Once everybody figured this out, you shout fire in a crowded theatre, everybody freaks out, heads for the exits, you get a liquidity crunch, you get into a financial crisis. We decided to bail out the system rather than let it fail because it was too big to fail. The costs of doing so were basically a 30% drop in tax revenue across the OECD countries because the financial sector becomes so big, particularly in the United States and the United Kingdom, that it was generating huge amounts of taxes. At the same time, the economy slows down as the liquidity crunch hits the real economy and affects lending and borrowing and spending. Consumer expenditures trend down as do consumer expectations, as do investment expectations. You get caught in a slump. Once you get caught in a slump, automatic transfers in the economy mean that benefits go up at the same time as tax revenues go down. So you're going to have a bigger deficit. As you have a bigger deficit, you multiply that over time, you issue more debt, you go from 61% to 100% debt to GDP. That's why we're here. There was no orgy of public spending. It's a lie. I take Amtrak every day. I would have noticed an orgy of public spending. If there was an orgy on public spending, it was on asset protection and income protection for the people who had made out with the most for the past 30 years when we bailed out those assets. That's actually what happened. Now here's the inequity of the put in this whole thing. Why is it that Social Security, which isn't even part of federal budget calculations on the deficit, which by the way has a $2.3 trillion surplus, that has to be cut so we can pay back the debt accrued by bailing out some of the richest people in our society and insuring their assets? Does anybody else think that's total horseshit? Because I really do. And that's why I wrote this book. Now, here's the weird thing. We're actually not in that much of a mess. It's been a sticky recovery, it's been a technological shock to a lot of service jobs that we didn't expect, etc. But nonetheless, we haven't been cutting, and because of that, federal deficit's projected to be around 3% next year, even with the margin of error on the projections, say 4%. Britain has its own currency, like us, and has been cutting, has been doing austerity. Having done that, it's now looking at 7% totally sclerotic growth and a possible triple-dip recession. Europe has been cutting like there's no tomorrow. They've got the leeches on the corpse and they're opening up the veins. Greece has lost 30% of GDP in 4 years. The German army didn't manage that between 41 and 45. That's how much damage has been done by this. So the question is the following. Why is it that Europe, particularly the European Union, the part that we think of as the most kind of, if you will, welfare state-ish, friendly, transfer, etc., suddenly became this huge doomsday device for this enormous experiment on austerity, which so far has cost around 30% of GDP in the periphery and has generated 25 million extra unemployed in comparison to the United States? Seems like something to investigate.
This is when you've got private debt rising, expenditure exceeds incomes. So it gives you that's the recipe for a booming economy. When you have debt being paid down, expenditure is less than income, and that gives you a depressed economy. So you've got people actually taking money out of circulation by paying the debt down. You're reducing the amount of money in the economy and reducing demand at the same time, hence the slump America's been in since 2008. Now, when that happens, because when private sector spending falls, normally government net spending rises because, for a start, the tax revenues fall and their welfare payments rise. So government spending tends to go in the opposite direction. So the increase in government debt has been a response to a turnaround from rising private debt boosting demand to declining private debt undercutting demand. So it's a bit like my best analogy is always an air conditioning system. If you have a room which is freezing, then the air conditioner comes on to warm it up. And that's effectively the government spending role in that system. Now, what they're suggesting is the room's freezing and let's drop the temperature. Okay? Let's take more money out of the system than the private sector's removing by also removing government money from the system. So what actually you do, you reduce the amount of money in circulation and reduce the level of aggregate demand. And that is supposed to be the solution to a problem where there's not enough aggregate demand. Okay? So it's easy to make the mistake of believing that's sensible because people extrapolate forward the idea about a household budget. And if you're spending more than you earn as a household, you've got to cut back on your spending. And we all, fall for that sort of reasoning. When you apply it at the household level, if you cut back on your spending, it doesn't mean you lose your job. Okay? But if you do it at a national level, if you have the entire society trying to reduce the rate of turnover of money and reduce the amount of money in circulation, it will reduce the number of jobs as well. So it's the wrong policy because it's focusing on the wrong type of debt. It's trying to reduce public debt when the real problem is caused by pretty much private debt. And it would be imposing austerity in the belief austerity will cause growth. Now, the best example I can give of how successful that policy is Greece, followed closely by Spain, with England not too far behind, well, a long way behind actually, but yeah, surely now looking at those examples you can say those are countries that have tried austerity and tried cutting government spending. What a fantastic success it was.
All right, so let's go on with this. Austerity, the Politics of Money, a Disconsolate Analysis. The title was actually given to me by Stephen. We had another title, and it had to do with the independence stuff, and that's kind of like passé now, I think. So basically, let's do this instead. So he gave me the title, this is what we're going to do. All right, let's get started. So why be disconsolate? Two wrong diagnoses, and you hear this all the time, and George Osborne wheels out a version of this all the time. So this is Wolfgang Schäuble. 2011 in the Financial Times. It is an undisputable fact that excessive state spending has led to unsustainable levels of debt and deficits that now threaten our economic welfare. Piling on more debt now will stunt rather than stimulate growth in the long run. 2015. The problem is that Greece has lived beyond its means for a long time and no one wants to give them any more money without guarantees. You've heard this. Now, this is the 5-year moving average of euro area government debt to GDP combined. It's flat. In fact, it's going down into the crisis. So where's the orgy of overspending? Interestingly, it comes around here in 2008. What happened in 2008? Do you remember anything? Might be like a giant global financial crisis where the entire global financial system got bailed at the taxpayer's expense. That might have something to do with a large increase in debt. Now, there's the Greeks. Well, we know they overspent, right? I mean, the Greeks, right? I mean, seriously, whatever. Well, actually, their biggest debt buildup is actually long before this becomes a problem. And in fact, if you have a look at this, they're pretty much flat going into the crisis. In fact, even the Greeks didn't overspend. But there was an overspend. Now, how can you have an overspend if people aren't spending? Let's have a look. Why are debts going up if the mantra is cut, cut, cut? You have to pay your debts, otherwise your debts will go down. Here's an interesting little thing. What you have here is the degree of austerity, how much you're tightening your budget. And here we have the change in the debt ratio. So what have you got up here? Greece, Ireland, Portugal, Spain. So what's this telling us? The greater degree of budgetary austerity, the greater the increase in the debt. That's that line going up. Now, why does this work? Well, basically, it's a denominator problem. If your economy is the denominator in the sum and you hack away large parts of it, the same amount of debt, the numerator, has to get bigger rather than smaller. It's a simple reciprocal relationship. You can have a look at this another way. You see the same thing, the degree of budgetary tightening. And then here's the growth of GDP. Look, it becomes negative really quick. Again, there's Greece. It's lost about 30% of GDP, and its debts have gone up 40% despite doing more cuts than anyone else. So the more you cut in a crisis, the bigger your debt gets because your underlying economy gets smaller rather than larger.